In 2020, a lot of startups faced problems and issues out there. So they actually did merger and acquisition. So what do you think when a startup should do merger and acquisition?
There are two kinds of mergers and acquisitions. One is when you're not doing too well. One is when you are doing too well, right?
What are some of the red flags that you see in startups out there?
Red flags are when founders are trying to build for the wrong reason.
So people actually say in Shark Tank that VCs don't help much.
The venture capital funds can provide large quantums of capital that angel investors cannot.
If you take 1 crore from LP and then you give it to a startup, what is the thing that you are getting?
Let's say I put in a crore at a valuation of 10 crores.
Right.
Which means I own 10% of the company.
If there's a big company and if I try to copy a company, then will it work?
Yeah, copying is not bad, although we have to understand that we're not copying the idea, we're just copying consumer behavior.
If I talk about blitzscaling and profitability, what should a startup focus on?
Startups should focus on market share and meet scaling.
What is a good answer for a founder when they are asked about exits?
But almost always great founders are extremely ambitious. So they will paint the picture of what is possible.
How did you know that this growth X needs money? So hi guys, this is Shreyansh Goyal. Welcome to my YouTube channel. So we have a very special guest with us who is none other than Jivraj. Hi, आप कैसे हो?
बहुत अच्छा, I'm having a great day and it's going to get better with this conversation.
How was your college life?
College was at St. Xavier's College, which is a part of the same institution. So I spent 15 years in the same school and college. It was really nice. I think I enjoyed it. I pursued commerce and finance, which was not what I intended on doing, but ended up doing that instead. It was great. In hindsight, I would have done more internships, got more hands-on experience, but I started multiple societies, etc. in college, so that gave me a good experience.
Okay. So I think you also did FRM, right?
Yes, I did FRM 2 levels and CFA 2 levels. Didn't do the third level while in college.
Okay. So like, what are these exams for? Like this risk management, right?
Yeah. FRM is risk management. CFA gives you a good understanding of the world of finance beyond sort of accounting, etc. Like investing. Actually, it's a US. Both of them are US certifications. I pursued them because the commerce curriculum in and of itself is not very extensive, so you get a lot of time at hand. And I was in a morning college, which meant I went to college from 6 a.m. to 10 a.m. So the rest of the day you had to yourself.
Okay.
And there was not much of like course pressure, which meant that you could do other things. That's why I think these two sort of courses helped me develop a good understanding of finance, what do you want to do in the future, and yeah, it was fun.
Okay. So you also plan to do your MBA?
No, not anymore actually. I got lucky to pursue other things in life, and what I'm doing today, which is investing and podcasting, leverage very different skills, and I feel I don't need an MBA in the traditional way that I would have if I was doing another job. So yeah, not currently.
Okay. So how did you join as a 7th employee at AngelList as an operator?
Yeah, so that was interesting actually. I tried to build a company when I was graduating college. This is COVID year 2020.
What was the name of the company?
It was called Score. We were trying to, two of my seniors actually did career counseling. So they were running a very consulting, dhanda-oriented lifestyle business. I came and mentioned that we should do an on-demand business in the same field, which meant that we build a marketplace. On the supply side, there will be a lot of people who are alums in Harvard, Wharton, whatnot, right? And if somebody was applying to these colleges, you could talk to them by paying for their time expertise depending on whatever amount they said. So you could be an alum from Harvard, set X amount per hour, and somebody would come and pay. Because it felt strange that Zomato Pay you can order food, Uber Pay you can order on-demand transportation. But if I want to talk to an alum from Harvard, Wharton, whatnot, I have to approach them on LinkedIn, reach out to them on Gmail. Those are unassured ways. So I was like, okay, we'll do this. But that didn't work out. And when the startup didn't work is when I started a podcast, which I continued running called Indian Silicon Valley. And that's become what I ended up pursuing post. Then I saw this opening AngelList, and AngelList in the US, original company, was started by Naval Ravikant, who's this like very acclaimed thinker in the ecosystem. So I was really inspired by his company. When I saw this opening, I'm like, I'll give it my all. I was not very qualified for the job because they said they needed somebody with 2 to 3 years of work experience. I didn't have that at the time. I was right out of college. I had built a company for 6-8 months. But they still took a bet on me because I had the podcast and I had something to show for. The podcast was also just a month old at that time. It was very rash, like it was audio only. I was recording over Zoom, so it was not very well done. But still, at the time, podcasts weren't as common as they are today, which is why they took a bet on me. And so AngelList India, I joined. They are, for those who may not know,
How did you apply there?
It was a very random job opening. Like I saw it on LinkedIn.
Okay.
I was like, I'll go for it. I remember somebody told me that like 500, 600 people had applied, so it was fun.
Okay. What were the things that you learned?
At AngelList, I learned a lot of stakeholder management. So I was responsible. I was a part of the business team, which meant that I was coordinating with a lot of GPs, general partners who were running syndicates. They were the people bringing deals on the platform. A lot of angel investors who were limited partners on the platform, and how to manage their sort of whatever they needed, product requests, growth requests, what kind of deals to invest in, compliance requests. All of that used to be my job. And then figure out growth channels. How do we get more investors and how do we get more of these LPs? So I understood that ecosystem very well. I learned to hang off business and sales because I understood, okay, if you have to grow a particular pipeline, what do you do to approach the right people? How long does it take? What are the processes that you need to keep in check? What is the entire ecosystem of that sales cycle? Sales cycle is a loose term for that, but that's what in its entirety I learned. And we were very young as in a company, but 2021 was a great year for us. So I saw a high growth company. We hired rapidly, many team additions. Everybody at the company was really nice. So I learned a lot from the people. I think it doesn't get mentioned enough as to how your thinking transforms if you spend time with the right operators. So a lot of my operational learning about culture, not just building the company, but culture, what is good behavior versus bad behavior, what is good ethic in terms of just working well, timing, leadership, all of that passed on from my experience at AngelList.
This was in which year?
2021 to 2023 end is the time I spent there. So almost 3 years.
Okay. So like I think that you also started your own syndicate, right?
Yes. That was in the year of 2023.
Okay.
So I invest in startups.
Right.
We've invested in 30 companies, deployed $5.5 million. This money comes from limited partners that I have known through my experience at AngelList as well as via the podcast. And we deployed in 35 companies. 8 of them have raised a follow-on round. Some of these companies are Stable Money, Mesa School of Business, Apps for Bharat, which runs a company called Sri Mandir, which is the consumer-facing application, Pant Project, which is a consumer company, Petal, which was on Shark Tank, and many others.
So you take money from LPs and you invest in companies?
Yes. There is a group of investors, individual investors, whom I will send an investment to. Now they can now decide to invest in that company or not. You can invest as low as 3 lakh rupees, but average check sizes go to about 7.5, 10 lakhs. And per company, I invest about 1 crore. So over a period of time, we've invested 45 crores as a quantum total. And then we give it to the startup. So on one side, there are LPs. On the other side, there are startups. I'm in the middle as a
mediator.
Underwriting the asset, which is the startup, and ensuring that the right communication, risks, and returns are communicated to the investors. And that becomes like a fund manager. The difference between a fund and a syndicate is that a syndicate requires approval every investment.
Okay.
Versus a fund, which has pre-approved, you take capital at once and then you apply at your decision making, at your command.
Okay. So I think if you take 1 crore from LP and then you give it to a startup.
Yeah.
So like what is the thing that you are getting?
We get a stake in the company.
Okay.
So by what we're doing is we're buying shares of a company.
Right.
In the hope that the valuation of the business will increase in the future. Let's say I put in 1 crore at a valuation of 10 crores.
Right.
Which means I own 10% of the company. In the future, let's say that 10 crore value becomes 100 crore because the company is doing well, has a lot of cash flow, product market fit has been reached. After rounds of dilution, I won't that, but my stake would reduce. It won't be 10%, it'll be lesser because future capital also comes in. Let's say none of that has happened, the value is only increased to 100, right?
Right.
I would still be owning 10%, so my 1 crore would have become 10. The way I make money is we get some carry. As a fund manager, I'm entitled to carry. Carry is a part of future profit.
Okay.
So 1 crore ka jo 10 crore bana, out of that is 9 crore profit.
Right.
Of that 9 crore, I will get 20%.
Okay.
Which is 1.8 crore. I will subtract that from the 9 crore, 7.2 crore, add the principal, 8.2 crore. And that 8.2 crore will get redistributed on a prorated basis, equal basis to the proportion of the commitment to the investors. That's the model.
And you will get 1.8.
Yes.
Okay, got it. I think that's a great thing.
Yeah.
Talking about syndicate investing and traditional investing, like what are the differences and what are the challenges out there?
Traditional investing in public markets
Right.
or in startups?
In
Public
public markets and startups.
So public markets, it's very important to understand that public investing versus private investing is very different.
Right.
The fundamental characteristics are different. Public investing is lower check size, lower risk, more liquid, right?
Right.
But it also does not assure you similar returns, right? So
Got it.
lower risk for lower return. More liquid because you can put money into the stock market today, and as long as the market is active on on a working day, you can take the money out, right? There's a clearinghouse, everything is very streamlined. Information is very transparent, right? What you can read about SBI as a public company, HDFC as a public company, Sun Pharma as a public company is the same that I can read. So information is all across the board, and there's a lot of data available, etc. This is how public market investing is. In private markets, almost everything is actually the opposite.
Got it.
You don't have enough data. There's not enough transparency. Let's say you know somebody who's starting a company versus I don't. You have an information advantage. That is not the same essentially in the public markets. So there's information. It's a very high risk asset class, which means 9 out of 10 companies end up actually failing. This is the statistical truth, which means 90% companies fail. Only 10% companies win. So you're taking higher risk, but for higher return expectation. Usually public market investing will return anywhere between 10 to 20% in a good market like India. In the US, that might be 5 to 6% because it's a more mature market. Private companies and private investing will return 25 to 30% compounded over 7 to 10 years, right? That's the IRR expectation in a good fund. So high risk, but for high return. Liquidity is a question. You cannot take money out at any given point in time. You have to wait for exit cycles. In private market, exit cycles happen when a company goes public. So IPO happens and shareholders increase, which means your shares can be bought by the public. A company gets sold. We recently are going through the headline of Minimalist getting sold to HUL for 3,000 crores. That kind of an event happens. Everybody makes money. Usually these are the two scenarios, secondaries, or somebody buys your share. That's called a secondary exit. So IPO, acquisition, or secondary. These are the ways in which exits happen, and these are windows of exits. They don't come, they're far and few. They come in the middle. So you have to have patient capital. These time horizons are 7 to 10 years in the private markets, unlike in public markets. The check size is also different, right? Private investing is not open to everybody, whereas opening a demat account and participating in free markets, public markets, is open to anybody for as low as a couple hundred rupees as well, as long as you can buy one stock of a particular company, right? That is not the same in the startup world. You need to be an accredited investor as per SEBI laws. Which means you have to have a certain net worth. If you then qualify, you have to invest a minimum amount of investment per AIF. AIF is registered entities that invest in startups, right? That amount is usually at least 25 lakhs or a crore, right? So these are larger ticket sizes as well. This is the fundamental difference between public investing and private investing.
Got it. Since you mentioned about the profits, right? If a startup makes loss, then what would be like your stake? You have to pay 20%?
No. Startups making loss is funded by the investing capital actually. So let's say today a startup holds 0 enterprise value. Somebody gives them
1 crore.
1 crore. Now this 1 crore they can spend to get revenue of, let's say, 50 lakhs, which means there is minus 50 lakhs on the books, but that's already been paid for by the investor, right? That is in the hope that in the future as they grow. So why does a company take loss, by the way? Let's understand. Let's say I am producing shoes, right? And I'm a shoe brand.
Right.
Now my shoes sell for 5,000 rupees, but they're very premium shoes, which means I have to spend 10,000 rupees. Like, this is a very broad example, by the way, so don't take my precise numbers for it. It's very directional to understand.
Right.
So, but that means on a per order basis, I'm losing 5,000. But I'm losing that money because I hope that when I've lost 5,000, that same customer will buy another shoe from me.
Okay.
At which point my LTV, long-term value from the lifetime value from the customer, will be 10,000, which means I make no loss, no profit in this transaction.
Okay.
I spent 10,000, got 10,000. But let's say one more shoe is bought because my brand is so good, right? So that initial investment of 10,000 is now profitable because this person has bought 3 shoes from me. So companies make short-term loss so that they can in the future make long-term money. In the short run, because they're competing with giants like a Nike, Puma, New Balance, etc., it is impossible to make, sometimes in certain markets, make a profit on each transaction, which means that startups which are disruptive, innovative, trying to create a market will have to initially spend money and take a loss. But in the long run, they must make money, be profitable, because a business is only valuable if they make profits.
Right.
But immediately startups may not make money. In the long run, they will always make money, like any good enterprise.
Got it. I think since you mentioned these points, so if I talk about blitzscaling and profitability,
Yeah.
what should a startup focus on?
Startups should focus on market share and blitzscaling,
Okay.
precisely because if you have enough market share, you can eventually win. That's the same thing that's happening in today's, by the way, quick commerce wars, right? There is Blinkit, Zepto, and Instamart. Broadly, these 3 players. Flipkart Minutes is now entering the market. Big Basket is entering. Rumors of Amazon also entering. But we'll, for this argument, let's say consider these 3 companies. Now, they are not completely profitable on each transaction on quick commerce today, but there's line of profitability. But each of these 3 companies are fighting for market share today. Market share is equivalent to how many dark stores do you have, because dark stores is equivalent to what kind of pin codes can you serve. If you are on higher pin codes, you can service more customers. If you are on more customers, then they'll give you more of their wallet share. You will become profitable over a period of time, which means all of these companies are fighting to gain market share, which means you blitz scale. But eventually, like happened in the Zomato and Swiggy case, Zomato has higher market share in food delivery. They are now a profitable company. They're more valuable. And let's say only the Zomato business, food delivery business versus Swiggy. And compounded on top of that, Blinkit is bigger than Swiggy. Blinkit is bigger than Instamart, which is why they also sort of, as a group, are bigger. So it's important to understand that if you have market share as a startup, you will eventually be able to gain profits, and thus profitability will come. It will just be delayed profitability, and you focus in the short run on growth levers, on capturing market share, on capturing attention, building consumer habits. Like people say, when they are hooked onto a Zomato and Blinkit, they don't move because there's customer loyalty. Your brain is wired to use the same things again and again once you like the experience. So as startups, you have to understand that.
Okay, got it. I think these were some of the amazing points. I would like to know, like, what are the things that as a mediator you check before entering into a startup?
Sure.
Like the plus points, what are some tick marks that you check on?
Sure. As a startup investor, I have to evaluate whether or not this can become a large company in the future. And there are usually 2 to 3 elements that go into it. One is the team itself. So you have to evaluate very strongly what the co-founders are up to, why they are doing it, what is their motivation, will they build for the long run. All of these things are very important. How deep are their consumer insights? How hustly are they? Have they done execution before? Have they led teams before? Do they have an ability to hire well? Do they have an ability to sell well? These are all very important components of the team. So as an investor, you have to double very well index on the teams itself, because almost always startups are doing something very new. So you can't predict too much of the future, right? Like before Zomato, there was no Zomato. Before Urban Company, there was no Urban Company. All of these companies are very new endeavors. But the startup, the founders have commonalities. The Flipkart founders, the Zomato founders, they were hustly, execution oriented, would get their hands dirty, very dreamy eyed, large ambition, they very good camaraderie between the co-founders. But the second part is, if the team checks out, is the market itself, right? Is there a need for what you're trying to build? How deep are your insights? Is there an opportunity, right? So let's say maybe flying cars were a bit early for today, right? But in 2008, when Flipkart started, there were macro levers and tailwinds which were in your favor, which is that, okay, e-commerce has to come in. Amazon had proven that in the US, which meant, what does that mean? That people will transact goods over the internet and they will find an efficient way to get goods, because earlier you would have to go to the market, search for everything, spend hours at aisles, negotiate with somebody, and then get a product. Now you can do that in the click of a button at sitting at the comfort of your home, which meant that this would become default. It's just about which approach would win. That is why e-commerce was one of the things that would definitely win. Then it becomes a factor. Market exists, which is the best team to win, right? So you have to evaluate the market very well. Is the opportunity deep enough? What are the founders trying to do? Why is that particular approach better? So for instance, Zomato from 2008 to 2015-16 was just doing delivery listings, right? There were food restaurants were listed. You could call them, you could order. There was no food delivery. But then a wave of food delivery startups came in, and when Swiggy launched, they only launched with delivery, right? And their insight was that if you have to just creating a discovery platform for startups for restaurants does not work. You have to own the fleet of logistics where you go and deliver the food as well, because the customer wants everything at once. You can't rely on restaurants having their own fleet, right? That was the earlier model. So now Zomato also saw that, they recognized the opportunity, and they built on top of that. So that is a good example of saying you have to recognize the market opportunity. Many such examples. All of the famous examples today that we see are the same, right? What did Zepto recognize? Zepto recognized during COVID that people wanted convenience. Instead of going to the kirana store, they were willing to pay a premium but be able to order order groceries efficiently and get it in time, right? They didn't want to wait for half an hour, one day, whatever, right? Like not even for an hour. They brought the 10-minute delivery concept into the ecosystem. Blinkit followed suit. Blinkit is now executing extremely well and better actually in terms of market share. So you have to check the market, you have to check the team market. Then you have to check, I think Kunal has a very interesting theory called the Delta 4 theory, which is that is the new behavior versus existing behavior. Is there a it's on the solution, which is there a 4-point difference? What does that mean? Uber is a good example.
Okay.
Pre-Uber in the US, pre-2008, the way you would hail a cab is by shouting, right? You would stop a cab on the street. That was the non-New York. If you see any movie pre-2008, you'll see that, right? Any Hollywood movie will have it. But that was very unassured, right? In peak hours, you'll not find a cab. You'll waste minutes on the road just trying to hail one. So the Uber founders thought, okay, we'll figure out an application. We'll aggregate supply of cabs on one application, as we all know how Uber is, and you'll be able to book, any customer will be able to book a cab. You'll be able to see when the cab has arrived on your doorstep. You can just walk out. It saves a lot of time. It's predictable, transparent. You know how much will it charge. You can pay in advance, all of that. So this behavior compared to hours of waiting, minutes of waiting, uncertainty, standing on the road, having dressed, and waiting for a cab, being late to meetings, all of that got solved, right? So this you could say is a change in behavior which is significant. So the new behavior of being with Uber is better, at least 4 points, than the old behavior. So you have to check if the solution in and of itself is powerful. And maybe the fourth part is timing itself, right? What does that mean? In India, we've gone through some waves of, let's say, UPI, which makes payments on the internet very smooth. We've gone through the Geo wave, which makes internet connections very useful, right? Now we've gone through COVID, after which there are certain trends which are in motion, more online spend has happened. Now, if you were doing some of the things that you're doing today, let's say urban company in 2010, when people weren't able to pay on the internet as smoothly as they can today, when they weren't as active on their devices because internet connection was very costly, when convenience was not as valued because macro levers of spending weren't as high, you wouldn't be able to build an urban company, or it would be significantly more difficult. A good example is Zerodha and Grow. Zerodha was started as a company in 2008. In the current version, they were started in 2012, right? They were a stockbroking platform on the internet.
Right.
Grow does perhaps the same thing, right? And they're very competitive in nature. Grow was started in 2016. The advantage at the time was more education in the market had already happened. Geo had already come in. UPI was already established. And those are factors that played to their advantage. And now they are both hand in glove in the same market, both equally great platforms and doing really well. So that's a good example of saying that timing also matters. You can't be very early to a market, right? That's the other thing that you have to notice. So if you underwrite some of these things, you probably are able to evaluate if a startup will be successful or not. And that's my theory.
I think there are some of the great points here, like timing should be there, team should be great, and like you have to bet on the founders as well.
Absolutely, 100%.
So I think like the examples that you have taken are like similar examples, like Zomato, Swiggy, if I talk about Uber and Ola.
Yeah.
And I think these examples are like copied ideas, right?
Yeah.
So do you think that if there's a big company and if I try to copy a company, then will it work?
Yeah, copying is not bad, although we have to understand that we're not copying the idea, we're just copying consumer behavior.
I think I have heard this Akash of Zip Electric saying this, that you can copy a big idea and make it big.
Yeah, 100%. So I think, in fact, no idea is today original. So most ideas are inspired, right? Somebody in the world, some places, of course, done everything that we've thought of. Unless you're a scientist making discoveries from scratch, which entrepreneurs are not, they are taking inspiration from consumer behavior. So it's nothing bad to copy, but you can't copy something face to face or directly as it is. You have to make tweaks. Ola is a good example, right? Ola realized a lot of things in India would turn out to be in the same way that was in the US, but you have to Indianize the solution. You have to understand the Indian consumer in depth. So you copy a majority of the inspiration. So what do you copy? You copy that people want convenience in travel, which means something like Uber should exist, right? It's just because consumer behavior has shown that. Something like, okay, people want to order food on the internet. People want to transact e-commerce on the internet. People want efficient payment systems, which is why Paytm exists, right? All of these things are just how customers in developed economies behave. But then you have to Indianize the solution and see what works, what does not, right? Flipkart has a majority market share in India. Why? Because they understand that assortment has to be a particular way. They have to understand search has to be in a particular way. Android phone users use Flipkart in a different way. So you have to Indianize the solution. And by the way, we're getting a lot of India first solutions as well. Urban Company is a very India first solution. Urban Company in the US. So US is a very developed market, but US is people will figure it out. It's not a do it for you market. In India, people want that convenience. They want everything to get done, right? Which is why, let's say, by the Oyo is an India first example. Urban Companies are India first example. Pristine Care is an India first example, which is Oyo for healthcare, right? These are all distinct India first companies because the Indian consumer has its own nuances, and thus you have to value that. So you understand consumer behavior, you take inspiration, but you don't copy end to end. You copy a better version, you copy the inspiration, and then you build on top of that with nuances in India, and you will be able to build a good business.
Okay, got it. I think talking as an investor, do you bet on the founder or like the company?
You mostly bet on the team that is building, because eventually, ideas transform, markets change, challenges arise, but you eventually know that the best people will be able to figure it out. Zomato is again a great example, right? They didn't start off with delivery as an example. In fact, the first time delivery came up, they were like, we'll not do it. They were late to food delivery. Yet they are the largest internet company in the country today with about like 20 billion plus market cap, right? So that's a great example to say that the right people in a decent market will be able to figure it out. Yeah, it can't be a market that can't exist at all, right? Like, I mean, it's very arguable when flying cars will happen in India, right? Maybe in a developed market they will. But although there's a Starlight Aviation, if I'm not wrong, is this company got funded in the flying market, car space to solve for the traffic problem. But it's still very difficult to imagine, right? So you have to have good markets, but great people. Great people build great companies. Ola is another good example, right? They were doing cab hailing, consumer tech company, but they realized that EV will be a strong opportunity. Simultaneously started Ola Electric, which is a really large public company above $4-5 billion in market cap, doing incredibly well. So you have to know that the right people who are outlier founders will eventually build large companies. Flipkart, another great example. They were getting e-commerce right, but they also spun off another company called PhonePe, where internally they started, funded it, then they externally got funded. Very large acquisition again. It's valued at $10 billion. Flipkart itself is a $16 billion company. So great people build great companies. That's the bottom truth, because these are such innovative companies that you need. There is no substitute to great people. If you are betting only on the market, that's doubtful to win, because in a good market also you need to select the best team.
Okay.
Yeah.
I think talking about like when did you start investing? Like what was your first venture that you invested in? And like how did you come to know that like I can also try and do investing?
So I was at AngelList India, and so when I was talking to a lot of investors, I realized how investing works. We also talked to a lot of founders, so I would understand what is the funding requirement, why do you need capital, how do you assess how much capital do you need, and all of these learnings were very instrumental in shaping my thought process in terms of why does a company need money, what does an investor think of when investing capital, and how do the two get married, right? So I realized that hey, access matters. What does that mean? I, as an investor, need to understand who is raising capital, who are the good startup founders, what do I assess in them. So, access to great founders matter. Then, understanding of businesses matter, right? At the early stage, you are working with very little data points because the companies have not started or are barely starting. So, it's not enough to form your judgment from a data POV. What you're evaluating is fundamentally whether or not a business will do well. So, you need to have good understanding. You need to have good judgment of picking the right companies. And then the founders who are raising also need to respect you enough to take your capital, right? I mean, private market investing, it does not matter how much money do you have, right? Like between us, let's say you have 10 crores, I have 1 crore. But if a founder, it does not matter you having 10 crores. You have to know who is raising.
Right.
Then you have to reach out to them. You have to ensure that you can underwrite the business. And then you need to convince them to take your money. All of those advantages may exist at lower quantums of money. So I had the advantage because of my podcast that, you know, I knew founders, I was able to underwrite businesses, I was able to understand them and then go to founders. So that's how I started. And the first deal was very interesting because I was not very sure. I was doing this for the first time. I was decently young at the time.
Which year was that?
This is end of 2022.
Okay.
Our first investment went through in Feb 23.
Okay.
So it was a very interesting time because all of this is such a new experience for me. But I had some great people around me. So the benefit of doing the podcast has been that I've been exposed to incredibly generous and nice people who have put in a lot of time and energy to help me succeed and win in life. And I'm in that journey, but having great people helps. So my first investment was in a company called, I think it was GrowthX. GrowthX is this known sort of education venture. They were running cohorts on the internet to upskill people.
Okay.
Now the opportunity was clear, right? Like people who are, we forget learning mechanisms beyond undergrad, or people who pursue MBA or master's degrees do their postgraduate programs. But when you are a corporate, you still have the need to learn, but you don't have the mechanism to learn very effectively. Companies like Upgrade, of course, do this, Udemy in the US, etc. Right? So online certifications were becoming a thing. Online education was becoming a thing during COVID as well, right? Because people were not going to offline centers, and also corporate folks don't have the time to have a classroom education, right? Not everybody does. So there's a company called OnDeck in the US which was doing this. We saw GrowthX had really high NPS. NPS is Net Promoter Score. People were very happy with the quality of education. The community that they had was really good. The people, the founders who were running the company were also the instructors. So they had deep domain experience. They were themselves operators. So they understood the pain points. And so it felt like a great opportunity to partner with a company wahan jahan business banna chahiye, right?
Right.
And that's when we went ahead and made that investment. So it was great team, decent market, timing, all of the 3 points that I earlier mentioned as well. And the solution also was very efficient. So everything just mapped well. And so we went ahead with it.
Right. Talking about this GrowthX, so how did you make that investment? Like, so basically, how did you know that this GrowthX needs money?
Yeah.
So wanted to know that part.
It was a very serendipitous thing, actually. I stumbled upon it. I was talking to the GrowthX founder. I reached out on LinkedIn and I was like, hey, love what you do. And on the conversation, actually, it came up that they were raising a round.
Okay.
So it was very lucky that I stumbled upon it. When they said so, I was like, okay, maybe I can help them figure it out. Also, what they needed was capital, not just from a money POV. So the good founders in the world of startups always get capital. It is their choosing as to whom to take capital from, because that becomes an important thing. Like the same 1 crore coming from 2 people, they will choose the better 1 crore. How do you define the better? It could be many things. It could be operational expertise. It could be network effects. It could be distribution. It could be marketing depth. N number of things, right? So what you have to realize is I focused on they needed people who were operators, because who was coming as a customer for them? People from Mama Earth, Spinny, Flipkart, all of these people, right? Because they wanted upskilling.
Right.
And so these are the kind of people who were in my network, because I run a podcast and I've hosted 50, 60 founders, all of whom have some capital,
Right.
most of whom have some capital, and they want to deploy it in startups. So my capital that I was bringing in from my LPs became valuable to these people, because these people had something to contribute beyond the money that they were putting in. Because if a founder already has the optionality to get money from n number of people, they will choose the best form of capital. And the best founders will always have a choice. So you have to make your capital not just available. So it's not enough to know which startup founders are raising. You have to go the extra mile of understanding whom will they take capital from,
Okay.
and then become the choice of capital.
Okay. Since we are talking about the choice of the capital, like there are VCs and there are investors, whom do you think actually helps more in raising the capital? And actually, if I talk about Shark Tank, right? So people actually say in Shark Tank that VCs don't help much. And I think investors help that much. So what do you think about that?
When it comes to venture capital funds and angel investors, everybody has their strengths. One is the venture capital funds can provide large quantums of capital that angel investors cannot. So let's say I want to raise 50 crores for my next round of funding. It is very difficult for me to accumulate that capital from angel investors alone. It's a very correlated relationship. It's very symbiotic. Angel investors need VCs because their companies will need future fundraising. VCs also need angel investors because VCs are not people, they're wealth managers in a particular asset class, which is venture capital. They are not necessarily operators with deep experience of building companies. Angel investors are usually individuals who have deep expertise in different things. It could be somebody who understands performance marketing really well, which is why they are valuable to a consumer brand who needs performance marketing expertise, right? So angel investors have their strengths beyond the capital that they put in. The good part is also they don't fulfill the entire round, right? So they want lower amounts of ownership. Like a founder does not want to dilute more than 10 to 20% in each round of capital that they raise. An angel investor is not taking more than 1-2%, maybe 3-4% at the max, right? Maybe 5%. But the large portion of the capital actually comes from VCs. So
Okay.
angel investors don't take too much of your company, add value to the company because they are now a call away. When Kunal Shah invests in a company, he's a call away, right? That's the more important thing. Kunal Shah's, who's the founder of Cred, his expertise, his network, his insights, brainstorming with him are more important than the money he brings in. Whereas when a venture capital fund, right, take a Lightspeed, Sequoia Capital, which is now Peak 15, Axel Partners in India, all of these funds have a compounded knowledge over 10-15 years of investing. They've seen company journeys from zero to the fullest, right? So InfoEdge, which was invested in Zomato, has seen the entire journey. So now if I go to them as a founder who wants to build in a space which is India, consumer internet, they know how the Zomato journey played out. So they'll have a lot of learnings from it, which always becomes an advantage. And they can offer you large quantums of capital. VCs definitely have their own sets of advantages and disadvantages, perhaps. Angel investors have their own sets of advantages and disadvantages. There's a very partner-like relationship. It's not like founder has to decide one versus the other. In the early stages, it might be helpful if you're raising lower quantums of capital to go to only angel investors, right? They understand founders better, they can take early risk. But eventually, if you want to build a large enterprise, you have to raise from venture capital if you're building in the internet space, a high growth company. And VC funds will be the most helpful people as well when it comes to that overall relationship.
I think since a lot of founders, so basically, suppose let's take a founder, right?
Yeah.
The founder invests in 100,000 startups, right?
Yeah.
So basically, it has lot of investment.
Yeah.
So how does he focus on all of them?
Yeah. No, that's the thing. So a VC takes up 10 to 15% ownership. An angel investor is probably taking 0.1%, 0.2%, 0.5%. So when you're owning a small chunk in a particular venture, it does not warrant too much time and energy, which is why you can take small chunks of 100 companies. VCs, on the other hand, take large chunks of limited companies because they have responsibility. Also, one important differentiating factor is angel investors are deploying their own money. VC funds are deploying money that they have taken from limited partners. So they have responsibility of capital and returning that capital. in my own money as an angel investor, it does not matter if I don't return capital, because it's like I'm the benefactor and I'm the one who bears the losses as well, right?
Right.
What that means is you have more liberty, freedom, no answerability, less responsibility. And here you have a lot of responsibility, a lot of answerability. You can't just deploy at your own whim. So that becomes the differentiating factor. But as an angel investor, since you don't own significant stakes in companies, you can afford to spread yourself thin. And since it's your own capital, you can invest as much wherever you want.
Okay. So talking about your journey, you started from an angel investor, right?
Yeah.
And then you transited to a VC.
Yeah.
So like, how was the journey? How was the shift from angel investor to VC? I think your angel investor journey would have helped you to become a good VC.
100%. I think it's important to understand who makes a good VC investor. You're either an ex-consultant, so you understand business processes, you understand how founders talk or how leadership talks, you understand what critical thinking means, all of which are important for business skills. That's one way. You could have been a founder before, which means that helps you develop good VC skills. Or you keep investing for some time, you learn on the job by making mistakes, by making errors, and by winning. So I realized that, hey, I start small. You start with angel investing, then you start a syndicate, and now I'm raising a fund, right? So the journey there is just you learn by doing. There is no substitute to learning by doing. It's very much like any other thing, right? As a founder also, you start small and then you establish a larger company. I learned a ton as an angel investor. I learned how to be disciplined about price. I learned how to be disciplined about valuations and understanding, which is related to price itself. I understood how to evaluate founders. Like, you have to evaluate, as a VC, by the way, you evaluate 50 companies, you maybe invest in one or two, right?
Right.
That's a very broad sort of spectrum, but that's usually 1 to 2% is your hit rate of investing in the investing companies, and you learn from your founders. So I invest in a bunch of companies and I always learn about from them what works, what does not, what is good execution, what is not good execution. And that helps me develop a better viewpoint on what good companies and good founders do. And now I am ripe to raise a fund, because now I'm taking external capital responsibility at scale. The 50 crores that I have deployed is also external responsibility. So I was vigilant, but there was also LPs buying into the deal, right? Which is to say that they had a say, yes or no. Now that I'm raising a 150 crore fund, they are now trusting me with the entire capital and trusting me to deploy it forward. So that's higher responsibility, and I've shown a track record. We've shown successes. We've shown how our companies are performing. Our founders speak highly of us, and that gives us the confidence to be able to raise a larger fund.
I think we have talked about a lot about LPs, right? So what are GPs?
General partners are the ones managing the venture capital funds, and they are the people making the decisions on where to invest capital. They are the ones meeting founders, understanding if that company can do well, and then making the decision on whether or not to invest. GPs are far and few in the ecosystem. The ecosystem of venture capital is only evolving. The funds were established in 2005-06, which are the oldest, which means we are 20 years old as an ecosystem. In comparison, the US venture capital ecosystem is 50 years old, right? So we're still going through that journey. There are a bunch of interesting GPs at all of these firms, right? Matrix, Axel, Lightspeed, all really, really good GPs. And I'm on that journey as well now, so time will tell. But good GPs are ones that founders speak highly about. You have to remember that as an investor, whatever you do, you are still an investor. Founders are the ones that make companies. So you are as good as your last investment, your returns, and what founders consider you to be. Do founders want to partner with you? Are you truly supportive to the founder journey? Do you add value beyond the dollars that you put in? Are you a true person in the time of need, right? All of these things matter to founders, and founders are the kingmakers here. They make or break VCs, because if they do well, only then does a VC do well.
Okay. What are good traits of VCs?
Good traits of VCs are strong critical thinking is a must.
Okay.
You have to have great judgment of people. This is a very human-led business, either dealing with LPs, dealing with founders, most importantly. It requires a lot of good human judgment. Third is you have to be very good at sales broadly, because you are getting capital, you are selling to founders in a way. So sales I'm using as a term to not convert a transaction, but to just have ability to sell a vision, ability to sell a transaction from not a monetary lens, but a buying power lens, from a convincing lens. Sales is very important. Fourth, you have to have really strong hustling ability, not from an execution lens, but being out there. In venture capital, the defined hours are not very long, but you have to go above and beyond. I spoke to Niren Shah, who's the India head of Norwest Venture Partners, which is a very large VC firm. He mentioned that to date, from 9 p.m. to 11 p.m. to 12 p.m., he has calls with founders to be helpful and available to them, which means it's a very, very hustly job, and you can't just do the bare minimum and get away. If you are chasing excellence, you have to go above and beyond. Right after this recording, for instance, I'm headed to an LP meeting, and then I have a dinner with a founder. So the job, if you start counting hours of, okay, I don't want to do a dinner meeting with a founder, it is unlikely that you will succeed. That only means that you have to go above and beyond on the job, and only then do you particularly win. And the fifth, maybe in my opinion, is just a very strong sense of empathy to founders and the startup journey. VCs don't win when they get ahead of themselves and they think they are the ones making companies or making founders successful. That is absolutely not the case. And you have to have really strong empathy towards founders, because the founding journey is very, very challenging. Founders devote their entire lives to 10 to 15 years of their lives to one particular thing. A VC is dealing with 10 things. They're dealing with multiple investments, LPs, portfolio management, multiple different things, right? So their attention and effort is also deviated. The risk profiles are deviated. So you have to have a lot of empathy, which is, by the way, like founders have to have a lot of empathy for their customers. VC ka customer founder hai. So you have to be very, very particular about ensuring that VCs have really good empathy towards founders. Those are my top 5.
Okay, got it. I think these are some of the amazing points. I would like to ask, like, suppose there's a VC, right? And he actually wants to invest in a company X. Should he or she double down the investments out there in the same company?
Next time?
Yeah.
100%. So there's something called power law in venture capital, which is that 1 to 2% of your companies will make a majority of your returns. It's like, Pareto plays out, but in a different way. So if only 1 to 2% of your companies play out well, you have to recognize which ones are doing well and double down on them, because a lion's share of your investments will go there. Let's say if you were a VC in 2008 to 10 and you got Flipkart right, Axel kept putting money in Flipkart. Axel is the main VC that put in money in Flipkart. Zepto is another great example. Nexus Venture Partners is the lead VC in Zepto. They kept putting money every round since then so that their stake does not get diluted. The thesis and thought process there is, if you get one investment right in venture, you have to keep doubling down, because you will make more money by investing more capital in the successful company than by trying to find another successful company. If you understand that principle, you'll almost always make money. Directionally, this thought process matters.
I think we have some successful examples of this, like InfoEdge also.
InfoEdge Zomato
is a great example. I would like to ask you that I was talking to a VC. He told that we should not double down in investments, because we should have different set of scenarios of the founders out there. Like because if a different particular investor invest in the founder, so we will get all the different scenarios. Like I am not betting on it single-handedly. Like all other founders are also betting on it, because now if I bet on a company, right, the founder gets dependent on me, that he will only bet on this company and he will keep on helping me and supporting me. Yeah. So that's not great.
Yeah. So you should not increase your stake beyond a point, right? Okay. Like if you own 50% of a company as a venture investor, then the founder does not have, like, they should have a diverse cap table. You should ensure that happens, but you should maintain your stake so that your ownership does not get diluted. And I think that's a good rule of thumb.
Okay, got it. And talking about, like, you were also a lead startup project for Masters Union.
Yes.
How did you get there?
So Pratham, who's the founder of Masters Union, and now he started something called Tether. Right. I got a chance to host him on my podcast in, if I'm not wrong, December of 2022 or early 2023. Actually, sometime around that timeline. And when I got to know him, I hosted him on the campus of Masters Union. And so as a result, he really liked what I did at the time, and we kept in touch. We kept discussing what are different things that we should do. One of the things that came up was, let's do venture capital classes at Masters Union. So that's how I started. Like with the cohort 3 of Masters Union, we started doing some workshops and helping their students out to get venture capital jobs. For their 4th cohort, I started taking some classes. And then when I had more time at hand in 2024, I left my job in 2023 end from AngelList. I was talking to Pratham and he's like, hey, why don't you come and help our students to build the internal startup accelerator. So there's something called the Venture Initiation Program at Masters Union. And since I had experiences that helped me develop a strong thesis on businesses, I'm an investor myself, I started leading that bit externally. So my role was think of a Y Combinator inside Masters Union. A lot of startups coming up. Masters Union is a great place. Absolutely love what they do. If they are building a company, what is the help they need? They need strong feedback. They need connections and a network. They need to hire. They need capital. All of this can be enabled by the things that I bring to the table. I can give them strong feedback. I can provide a strong network. I can provide a strong network of investors. And so that's been a very interesting learning process for me as well. I have thoroughly enjoyed it. In the last cohort of Masters Union, the cohort 4, there were 20 startups, 15 startups that came up. 24 people left jobs to actually pursue startups. Out of them, 5 have been invested to. I've seen their journey from scratch. I have helped them out here and there to the best that I can. But they have done an incredible job executing and brings me a lot of gratification, satisfaction. I've seen the school also develop from, as early as possible since the 3rd cohort. So yeah, very glad to be able to do this. I today was also, in Masters Union when I'm in Gurgaon, I spent time with the students who's a part of the cohort. It's been a great journey.
Okay. Talking about, like, you are also involved as a venture partner at Tribe Capital.
Yes.
So how did you get that opportunity out there?
So, the Tribe Capital opportunity came in because Vishesh Khurana, he's the co-founder of ShipRocket. Yes, one of the co-founders. He is now leading Tribe Capital in India.
Right.
And Tribe is a US fund. They have $2 billion in assets under management, very large firm. I have hosted Vishesh, again, maybe 2-3 years back. So all of this is, by the way, you make luck happen for you in a way. And I got really fortunate in life. So Vishesh has now become a friend. We host dinners at his place. He's like an elder brother to me now. And so when he was starting Tribe Capital, he mentioned that, hey, you have connections to founders, some investors. Do you think this is something that could be helpful? And I also really got interested because to work with a US fund, which is setting up in India, was a unique opportunity for me. So the venture partner role entails me helping out with introductions every once in a while to founders and investors in the Indian context, because that is where they are establishing newly. Since I was close to Vishesh and he recognized what I bring to the table, he was very kind to offer me this, and I help them out every now and then.
Okay, got it. And what is a venture partner?
Venture partner is a person who is, so a partner at a venture firm is an investing partner. A venture partner is somebody who on a part-time basis helps out the fund in various capacities. Usually it's a scout-like role. So a venture firm is responsible to make investments. You get access to investments by multiple means. Some funds have the role of a venture partner to help them scout better opportunities. And that's my role at with Tribe India as well.
Okay. In 2020, a lot of startups faced problems and issues out there. So they actually did merger and acquisition. So what do you think when a startup should do merger and acquisition?
Honestly, you should. There are 2 kinds of mergers and acquisitions. One is when you're not doing too well.
Right.
One is when you are doing too well, right?
Right.
If you're doing too well, Honasa is a great example. Honasa is the parent company of Mamaearth. Now, Mamaearth established one brand really well. It was growing. They had network effects. They started another brand, Dermaco. But then they realized that there are other, actually Dermaco I think was an acquisition. Aqualogica is something which they started internally. But they now have 5-6 brands. So one strategy is to build brands internally. The other strategy is to buy a brand, and that becomes an advantage. So for a successful company, if there is more advantage in buying a company, because that is inorganic growth, because you have access to capital, you should do that. But if it is more efficient to start it by yourself, because what does it mean to start start a product line? It means human capital, time dependence, and attention. So if it helps to start one, you start. But if you want to grow inorganically, that option is always available. Shiprocket, we were just talking about Vishesh. Shiprocket is another good example. They bought Picker. Picker was in the same space. There was a really large acquisition, some $300 million, if I'm not wrong. They realized that it was just more advantageous to buy, which was actually Picker and Shiprocket, same space. They were competing against each other, but Shiprocket was bigger. They could either both continue raising money, or the larger would buy out the other, right? So those are examples in which a positive acquisition happens. But there are negative examples as well, right? If you're not doing too well, but you have good talent, what do? Your product may not be doing too well, but you can become a good home for somebody who needs talent, right? So these are acqui-hires, as they are called, where you hire the team to be able to build something internally for you. So a larger company buys a smaller company, not for the product, not for the traction, but for their team. There could be many other reasons as well, but those are reasons why that happens. Mergers, we're not seeing as much in the startup ecosystem yet, but I'm sure as companies sort of develop, we'll see more of that. Exits are also starting to happen. Again, Minimalist and HUL is a great example. ITC bought Yoga Bar. Marico Group has bought multiple companies as well. So in the consumer space, of course, it is helpful. So HUL, instead of putting up a small team of builders, not knowing where to start, HUL already has the advantage of large scale distribution, large scale marketing, access to a lot of knowledge, depth, right? Instead of building from scratch, they can wait to see which are the successful companies in the consumer space, which are the companies they don't have in the portfolio, and just buy. Right? So in the personal care space, which is Minimalist, they didn't have a new age company. They have, I think, Dove, etc. Some of these companies, they have some companies, but all legacy ones. They had no new age competitor. And new age personal care companies are doing really well. They're like, okay, Minimalist is doing well. Why don't we buy them? And they have the access to distribution, to general trade, to modern trade, where they can amplify a brand really well. Similarly, ITC has multiple, again, consumer businesses, but they didn't have anything in the breakfast portfolio. Yoga Bar is a company which has created great consumer recall, great brand awareness. And so they were like, okay, why don't we buy them out? It helps Yoga Bar because it gives them access to distribution, strong leadership, scale. These are things that maybe startups don't understand, right? Like HUL is at some, I don't know, thousands of crores of revenue. Right. And Minimalist is still at about 500, 600 crores of revenue. So it helps both these parties when it's strategic and helpful.
Okay. Talking about like exits, so an investor always thinks about exits, right? Whenever they invest in a company. So what do you think? Like, what is a good answer for a founder when they are asked about exits?
Investors want to understand the big picture, right? And everybody wants $1 billion outcome, the unicorn. If you're raising venture capital money, I think it helps for founders to share the realistic ambition that they have. You don't want to oversell, underdeliver. But almost always great founders are extremely ambitious. So they will paint the picture of what is possible. Like I was in fact talking to another investor, Nirain, I referred to him earlier as well. They invested in Swiggy when Swiggy was $30 million in valuation. For context, they are now a $15 billion company, right? That is, if I'm not wrong, 500x of multiple creation. Idea is that he was able to and he mentioned that Shreyansh Shah, who is the CEO of Swiggy, was thinking about being the best in the business from day zero. So you have to be a market leader. And the market has to be large enough, and you have to sell that dream. You have to believe in it. You have to not just sell it by saying it. You have to live it. You have to show for it. You have to execute. You have to prove it with insights. And if you're able to do that, that's the right pitch to a venture capital investor.
Okay. So does investors really care about exits, or they look what the founder is actually answering?
No, they care a lot about exits. So you do a lot of background math to understand if there is a possibility to even become that large, right? Many investors passed on Zepto because they never realized that quick commerce can be this large. It felt like it would never be profitable. It would be a small market. It felt very niche for a small portion of the audience who are very premium, who would pay for 10-minute delivery. But all of those things have been proven wrong now. So investors did a lot of math, and when they realized that, okay, this is a small market, they said we'll pass it. Or they were unable to imagine the future. In venture capital, one of the most important things is to imagine the future. Companies like Airbnb, Uber, Snapchat globally. In India, companies like Flipkart, ShareChat, let's say Misho, Zepto, were all passed by some of the smartest venture capital investors, because at the time of when they were launching, there were enough people who weren't able to imagine a world where people would transact. Like now we can sit here and say that, okay, it was obvious that people would buy e-commerce, e-commerce would be a thing, or Misho, social commerce would be a thing, or quick commerce would be a thing. But at the time, it was not obvious. You have to imagine the future. Think when Airbnb came about, the idea was that you will welcome you will welcome strangers into your home, and those would become hosts, right?
Right.
It sounded absurd to a lot of people that why would somebody open up their home for some amount of money? But people didn't realize that hosts would have additional real estate where they would make additional strong income because of Airbnb. Today, Airbnb is perhaps the largest hotel and accommodation, if we bracket it in that space, chain. It's a $80 billion plus market capitalization company. For context, there are only 4 companies above that market cap in India in the public markets, right? Of course, US is a more evolved market, but Airbnb is a classic example of a startup which is a truly venture backable company, because they did losses for, I think, 14 years till 2022. And in the last 3 financial years, including the one ending in April this year, they will do large amounts of free cash flow, billions of dollars, if I'm not wrong, some $6 to $8 billion will be the free cash flow amount this year for Airbnb. So when they start making profits, they make profits crazily, and this is a good venture example. So to your point, investors make a lot of assumptions, investors calculate a lot on the return profiles, and they have to rationalize it. See, because it's not your money.
Right.
You are responsible to deliver a return. You have to showcase how you will make that return.
Got it. Some top learnings as an investor?
Be very open to all kinds of things. My best returner is a climate company that I didn't know anything about when I invested, right? So you have to be open to most things, and you can't be closed out. This means that you keep an open viewpoint every time. Don't have a template on which founders win. We've invested in dropouts, we've invested in senior founders. They surprise you all the time. Don't have a set template to what wins. And the third, which is the most important, is you're constantly learning, and you have to not lie to yourself and be very intentional. What does that mean? You work with limited information at the time of an investment. So let's say today I make an investment. But the real investors and the real investing is in 3 months and 6 months of evaluating how did you actually think about things then and what is reality. If you're always iterating on this was what I consumed, let's say I assumed large market, but this is where I went wrong, or this is when I went right? So let's say I passed on Zepto in 2021, but in 2022 I had to accept that this is a large market, people are willing to accept. So my assumptions sometimes will not play the way everybody is assuming. Everybody is deducing based on current information. What you have to do is deduce again, conclude again every point in time, so that your thinking refines. And if your thinking is refined, you will almost always then be your inputs will be better, and eventually you will win. So I mean, these are 3 very important learnings, and I'm constantly evolving those. Hopefully I can, do justice to the business.
Yeah. So what are some of the red flags that you see in startups out there?
Red flags are when founders are trying to build for the wrong reasons, right?
Okay.
If you're, as a founder, trying to build because starting up is glamorous, it seems very attractive, it will make you famous, it will make you a lot of wealth, I don't think those are the right reasons. The right reasons, of course, there are many right reasons, but some amongst them are you have identified a strong space, you actually are unique in terms of what you want to accomplish, you have a strong reasoning to why you want to win. All of that matters, and then the other things can matter. Wealth creation is a completely good response for a founder, but it can't be the only thing you're chasing, because if it's the only thing, you won't be able to survive the low points, the challenges, because money doesn't come in fast or easy in starting up. You have to survive the low points to be able to make the money, right? I think that's a big red flag when founders don't start for the right reasons. Second is, in terms of just venture investors, I don't like when venture investors are just boastful or egoistic about them taking credit about what founders do. And I think the best investors aren't like that. The best investors recognize the founders are the prime drivers of success. And as a venture investor, your only job is to facilitate in a very, very small proportion. I think that's the second bit. The third bit is realizing that this is a very human led business. And so, what I don't think and what is a red flag is when people are extremely transactional. They're very short term oriented and they don't recognize and they try to cut corners, all of which is very short term thinking, right? I don't like those scenarios. And I think those are extremely red flags both on the investing and the founding side. It is very important to realize that in this business, you're human first, you're in it for the long run, and you can't just get by. Your word is your bond. If you're doing bad by somebody, that gets carried forward. You can't be too transactional because that's not how the world works. And you have to look at the long run. So I think if somebody is, all of those anti all of those, I think that matters. And you're at the core of it, it matters that you recognize that this is a human-led business. Starting up as well, right? While it is important to execute, and that's hash one. The second, in my opinion, is hiring the right people, getting the right investors, converting your customers well, all of which is mostly humans, right? Facilitated by technology. So you have to recognize these things, and these red flags are very important.
Got it. I think we all know your success stories, right? So some of your failures that you have learned from.
I think there's a lot in the sense that moments of doubt occur almost always. And those are moments where you feel like, why am I doing this? Why is this happening? On the podcast as well, it's taken me sort of 3.5 years to sort of establish an audience. And till date, of course, there's so much to be done. I'm not there quite where I want to be. On the investing side, there are enough misses as well. Like we only spoke about the ones that we got right. Not even much about that, but we've not spoken about things that we get wrong.
Right.
But the idea is that in these moments of failure, so is it moments of doubt when people don't trust you, moments of contention when, irrespective of putting in good work, you don't get as much distribution, be it with the podcast or irrespective of doing things intentionally with investing. Some founder may reject you, some founder may not want capital from you, some founder may not talk to you because they're caught up. All of those things, I mean, are problematic and are moments of doubt. But I think the way to get content is knowing that your inputs are something that you don't want to just win. You want to win predictably and you want to win in the long run big, which means in the short run, if you are losing out on something, you have to take it instead. You have to know what to improve and keep at it instead of letting that disappoint you. But the core of that is knowing that this is what you want to do. You can't be long term in something that you are unsure of, right? So you have to really be foundationally confident that this is where you want to be. So for instance, for me, that means that I'm confident about investing in the long run. I'm confident about building the podcast in the long run. I enjoy the inputs, which is why I'll do the extra parts without any extra incentive or short-term results. All of these are very important pointers.
Okay. What is your one success mantra out there?
One is difficult to quantify, but let me try. I really feel that if you give your heart to something, it be generic, you eventually win. So find something that feels like play and keep at it for the long run. Don't make short-term decisions and almost always you will win. My motto is the same everywhere. I love podcasting. I absolutely cherish it. Every time I'm in a recording, I feel like time flies. I love investing. Whenever I'm talking to a founder, I just absolutely cherish that time. I learn a lot and I'm always honest. And the third is with people, I'm just very fueled with energy whenever I meet somebody new. I learn from them. I care deeply and I'm super honest. So, I mean, that if you do all of that, and that comes from the core genesis of loving what you do and truly caring about what it is, right? And these are easy words to listen to, difficult to practice. If you can practice some of these fundamentals, I think life will be great.
I think you go 1 mile extra. I remember an incident that you called Sleepy Owl through Instagram. So I think that is one thing that 100%. Actually helps you every time.
Yeah, it does. Like going the mile extra, that's the thing, right? So if you love what you do, you will not, like, some of these things that feel extra for me. So you'll keep going the extra mile always. You'll keep hustling. You won't get tired. You will derive energy. And that will keep you on a pathway which is very, very significant.
Okay. What are some suggestions that you would like to give entrepreneurs out there?
I think entrepreneurs should start for the right reasons. They should value the long run, understand compounding really well, and start not because it is glamorous, but because it is truly their life's mission and purpose. Because otherwise, it is so challenging to start a company that you will not survive if you're not true to the mission.
Okay. Thank you for your time. It was great having you.
Such a pleasure. Thank you so much for having me.
ओके अगर आप लोग ने यहाँ तक वीडियो देखा है तो ये वीडियो को लाइक कर देना, और अगर अभी चैनल तक सब्सक्राइब नहीं किया है तो चैनल को सब्सक्राइब कर दो और बेल आइकन को भी दबा दो. चलिए मिलते हैं नेक्स्ट वीडियो में. थैंक यू गाइस.